You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. Welcome back to TWIFO, This Week in Futures Options, the program where, like the name says, we talk about the week that was and indeed still is from a futures options side of the fence. So maybe we'll talk a little bit of indices, maybe some metals, maybe some lean hogs. You never know who's going to make it onto the show. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever exciting Options Insider Radio Network. If I sound a little bit different, or if you've been listening to any of our content this week on the network, you know what's up. You know I'm down here at the big risk management conference here this year. Big event, talks a lot about tail risk and hedging in the indices and all sorts of fun stuff, volatility and so on and so forth. So if I sound a little bit different, that's why I'm beaming to you from sunny Florida as opposed to from our studio. But you guys can still get us every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, via the old Mixlr, or grab the podcast pretty much wherever you find your favorite podcast programs. We're just that dedicated. Even though we're traveling hither and yon, I'll make sure you guys get your fill every week of all things futures options. And, of course, however you listen, live after the fact. However, make sure you hit us up, questions, comments, insights, all that good stuff. We do like to hear from you guys. A little bit of a role reversal this week because usually My cohort, Mr. Nick Howard from Bantix Technologies, is the one who's out and about. And then when I'm in the studio this week, Nick's back in holding down the fort in Chicago, and I'm out and about. So, Mr. Nick, welcome back to the program. A little bit of this week I'm from an undisclosed location, even though I just disclosed it.
I'm in the office, but I'm going to sit underneath my desk today, so we're at least in two different locations than we usually are. So I'll be broadcasting from below the desk today.
Crazy end to a somewhat crazy week. We had threats of trade wars, and tariffs really spooking a lot of the commodity markets this week. Then towards the middle of the week, we saw all of a sudden maybe Rocket Man and Trump going to sit down together, so that seemed to calm things a little bit. Then today's number coming out of the non-farms really just setting things off to the races. It was kind of an interesting number. I think on our last show, Nick, someone actually referred to it as a Goldilocks, like a super Goldilocks number, because it had that weird combination of non-farms. Of course, they were expecting 200,000 payroll increase. They got 313,000, but at the same time, the wage growth was much below what they expected. So it's kind of that magical combo of growing the economy without inflation, which, of course, we all know the Fed very, very into inflation these days. So kind of interesting stuff. I know, Nick, you're an old EuroDollars guy, so you always played a lot of the old non-farms and Fed watch game. What are your thoughts on that number we saw today, as well as kind of the topsy-turvy week we've seen so far?
Yeah, actually, I heard somebody refer to it. You're the second person who said Goldilocks. I was on the phone pretty much all morning, so I didn't pay too much attention to anything that was going on. I saw the numbers, but I didn't get to read anything. It has been sort of a topsy-turvy, turbulent week. The treasuries and the EuroDollars, they're swinging around pretty well from a movement standpoint. Not really getting outside of any ranges so much, but definitely seeing some action there. And again, having the big growth, that's got to be some sort of seasonal thing. I didn't look at what the adjustment was from last month to see if there was anything adjusted down, to see if there was even a double whammy or not. But good to hear those things, I guess. We don't like certain people to take credit for those positive numbers on my side of the fence. But yeah, I think it didn't appear to do too much from a moving stuff around in the treasury market. I mean, we've been seeing sort of a range there. So as much as it was a Goldilocks number, I don't think we did too much to promote anything. And the only thing that I would probably look at, and I looked at it only from the possibility standpoint, I didn't look at it from a historical standpoint. The Fed Fund, the Fed Watch tool has us at about almost a 90% probability of a quarter point hike, and that didn't change so much from a day ago or the day before ago. So even with all that good stuff, people were already pricing in the fact that we were going to see another rate hike. So you would think that if it was going to be super Goldilocks, they would say, okay, we have wages growing with no inflation. Maybe we better rethink that again, because I know they're trying to get ahead of the inflation with the rate hike planning of 3 or 4 this year. But so we'll have to watch. I mean, nothing's really taken this rate market out of its range at this point. So I don't think good news is going to necessarily do it. Bad news, people want the bad news, so it goes down as opposed to the other way.
Well, since you mentioned rates, let's kick it off there. We don't get a chance to dive into rates too often. I know the 10-year has kind of been on your radar a bit this week, kind of just touched on it. Net movement, it hasn't been too much over the week, only off a quarter of a handle or so. So that's not really what's catching our eye, even though the vol did come in a bit this week, about a point, pretty much across the board, a little bit less out there in the farther portions of the term structure. I know the skew's been catching your eye, so we'll get to that in a second. Let's look really quickly and see what's been lighting it up out here from an options perspective. It seems, by the way, open interest, actually a pretty strong week, up nearly 11% OI out there in the 10-year. So all you're looking for some place with some action, it was here this week. And number one with the bullet, the 119.5 puts out here in April, Mr. Nick, doing a whopping nearly just a little bit under 200,000 contracts out here. So a pretty strong week. Monday, the big action day, 78,000 contracts going up on Monday. The rest of the week kind of scattered again, just a tick under 200,000 total on the week. Of that, nearly 50,000 net closing. So just a lot of action. How many products you talk about, Nick, on the show that don't even do 50,000 total in volume for the week, and here it is doing 200,000 on one strike out here in the 10-year. So when this thing wants to put up some numbers, it certainly can. Again, the 10-year actually setting out right around 120, so the 119.5, about a half a handle below where we're looking here. The 120s, though, also lighting it up this week to the tune of about 114,000. These are the puts, by the way, listeners. 114,000 contracts. The lion's share, again, on Monday, 66, almost 67,000. Again, net 114,000 on the week. Again, about 31, almost 32,000 opening there. So the 120 and the 119.5 puts definitely leading the charge this week, kind of number one with a very, very strong bullet. Also saw the 120.5 calls, pretty tight range out there this week. Again, all this in April. Number 3 on our list, 84, almost 85,000 of those. Again, Monday, the big day, about 30,000 going up on Monday, 84,000 total on the weekend, about 5,000 net closing. So a lot more back and forth on the 120.5 strike there on the calls, which is kind of interesting. But we did see paper pretty scattered, about 45% of it coming in this April contract here, which again is not exactly surprising for this product. But I know, Nick, I know the skew out here is really kind of catching your eye, maybe for the fact that it hasn't really moved so much. Is that what's catching your eye out there?
Yeah, I think there hasn't been too much of a change, but I think what I mentioned to you when I sent the note, and I had to go back to remind myself because I had actually been across a bunch of products today with some of my phone calls. But if you look out at the April's got about 14 days left to expiration. But you look out in the May and the June contract, that's about a 42 and a 77 days to expiration. It's a pretty balanced looking vol curve. So what are you saying? What does that mean? It means that when the quick skews basically measuring you can measure it for any delta volatility in terms of looking at the ratio, but we look at the 25 delta, and you're seeing the calls and the puts are kind of weighted fairly evenly. So, and we mentioned it a little bit in the beginning, and my comments sort of tie into what I saw here as well, is that it looks like it's almost anybody's guess in terms of the direction we're going. There's not a real, you might see a little bit of discrepancy in terms of richness or cheapness from the 25 delta put to the call or vice versa. But, at the start of the week, it was very balanced. It's still pretty balanced, maybe a little bit more biased to the put than there was when we started on Monday. But we're very rangy in our trade here, and the vol curve is sort of telling us we're not really sure which we're going. We have a kind of an equal probability to go either way. So it will be something that we got to keep our eyes on as we move forward here to see if we start to get any bias. Even if we look at the put call ratios in the volumes this week. They're a little bit better than one, so a little bit more bias to the puts, and that probably is why we got a little bit more of an imbalance towards the puts as we head into the close for Friday. But all things considered, it looks like that at least on the 10-year part of the curve, people are generally undecided in which direction we're going to end up.
Speaking of product categories, maybe we don't get into too often here on the show. We bring it up every now and then. Our listeners seem to like it when we do. It was certainly in the news again this week with all this talk of trade wars and tariffs, Mr. Nick. Our old friend Lean Hogs. Maybe it's time for a little more hashtag hog love on the show. They hit a 3-month low coming into middle of this week, partly spooked by all this talk of trade wars. We do actually export about a quarter of the pork produced here, so that would certainly hurt us if we did get into a back and forth battle over tariffs, and we saw the hogs moving as a result. Net on the week, it actually wasn't, even though movers and shakers wise, we'll have to get to that in a little bit, even though net on the week right now only off, looks like about net about 4% on the day, or maybe a little bit less actually. But what we saw here in terms of actually open interest up nearly 8%. So that's a good week out there in terms of all things lean hogs. Again, we were talking before about how the 10-year did 200,000 on one strike. You're not exactly seeing the same numbers in all things lean hogs. You're talking about 2,000 instead of 200,000. So a little bit different from a volume perspective. But again, it was the front month April 70s. If you're wondering what's going on out here, the strikes kind of all sorts of crazy out here. Right around 68 is around the front month at the money for the hogs. And like the 70 calls, doing about 2,000 contracts this week. The lion's share actually coming on Wednesday again when we hit that big low, about 1,000 going up on Wednesday. So roughly half the paper going up there. We also saw the 82 calls going up out there in June, doing about 2,000 as well. Again, the lion's share on Wednesday and again on Thursday, about 850 each. Actually, one contract difference, 857 and 856 on Wednesday and Thursday. Net opening about 1,100 contracts on the week out there. So some interesting upside call positioning. We don't have to spend too much time on this, Nick. I thought it was kind of funny. The lean hogs were actually in the news this week, so we kind of had no excuse. We had to bring them up. Our listeners loved their hashtag hog love, Mr. Nick. Don't you know?
And it's funny because I read the show notes and I obviously took a look at what we were going to try to talk about via the This Week in Options, which again we forgot to mention is live right now on the CME Group website, cmegroup.com/quickstrike. Look for the This Week in Options section, and you'll be able to follow along and click in and get the historicals and get the in-depth charts that we are discussing as part of the show. But you would have thought if there was, since the market's been down for the last couple months. If you go look at the history of we're trading up around 78 2 months ago in the April contract, and now we're down up to about 67. So as much as the tariff talk might have pushed it down a little further, you would have expected if there was a big fear like that in terms of the price, that we would have seen a little bit more pump in the puts from a skew standpoint. And the reality is we really didn't see that much go on here at all. So as much as the market might have been affected, it hit a 3-month low, right? But it was already trending down. So the tariff talk just sort of exacerbated part of the problem, but it's been nothing but moving down over at least the last couple months. I looked at it, didn't even go out to the 3-month mark here. I'll go out one more piece and look at 3 months, and we started back. It's actually really more of a 2-month trend, I think, more than anything else. The beginning of middle of January, 8th of January, we were around 70, 76, 77, and we've been nothing but down since then. So yeah, maybe some tough tariff talk. That's my alliteration for today, but I don't think that really added too much to the downside of the hogs that we've already been seeing over the last couple of months.
Yeah, right. It is kind of funny because after I saw the initial news about lean hogs, I did some digging in the old quick strike myself, and I had the same conclusion. I thought they would be moving a little bit more, or perhaps at the very least, changing their trajectory from what we've seen on recent shows, and that it got exacerbated. You're right, but it didn't exactly change the ultimate trajectory of what we've seen out there. So there you go. All you've been bugging us to get a little bit of livestock back on the show. There you go. You got some this week. Let's move on to our other friend, Mr. Nick, old stalwart on the old program, the Texas Tea, the black gold, WTI, crude bulls, a little bit of a smile on their face, getting some of what they gave back last week, getting some of that back. WTI is settling out around the 62 handle, up a little more than 1% from where it was last week. Last week, was off right around 61, 60 and a half in that range. So up a little bit more than a handle here this week, settling out the week. So a little bit of an upside move. We said on the show last week, we said many times, if we see it retrace to the upside, we're not going to see the vol hold up. And that's pretty much what we saw yet again today. Vol, as low as it is, all the premium they got last week coming back in again in spades, off point or more across the board here. It's a little bit less out in the farther end of the term structure there, but still just a lot of vol coming in. So as cheap as it is, it can get cheaper. That said, you're still getting some underlying movement, so you still can probably pay the rent. I'll let Nick check his rent gauge to tell us for sure. But it's always a challenge when the vol comes in aggressively when you do indeed own it. In terms of OI, kind of a quieter week for WTI, only up about 3.7% net change in OI this week. And where the action was, it was once again in our old friend April, just a little bit over 50.5% of the volume coming in that front month contract, which is a weekly at this point. It's got 6 days to go, which we said many times. Clearly, people have no problem trading short duration contracts in WTI, just for whatever reason, not the official ones, not the weeklies. But when the monthly gets down to that range, they have no problem trading, which I think, Nick, reinforces your point you said before, that you think the issue is probably something in the mechanics of the way it's quoted, the way it's available on certain platforms. And I think this kind of paper tends to make me concur with those conclusions. In terms of what number one with the bullet was out here in WTI this week, If you were going to say, we said before, they like even strikes, even numbers out here in WTI. This week was no exception. The April 60 puts leading the charge, just a tick under 50,000 contracts going up on that strike this week. The lion's share actually today, 13,500 going up today, followed by 12,700 on Wednesday. Those are the two leading days. The rest of the week scattered. Net, actually, it's been almost exactly back and forth, only about 700 contracts of those 50,000 net opening. So a lot of back and forth on that 60 strike. Again, that's to be expected. We see this kind of week after week, a lot of aggregation of liquidity around very even strikes in WTI, and that was the case again this week. For our number two option, we actually drop off quite a bit, about 22,000 contracts fall off, down to the 58 puts also in April, doing about 27,000 contracts this week. The lion's share again on Wednesday with 8,000 contracts there, 6,000 today, and the rest kind of scattered throughout the week. About 1,200 opening there, so a little bit more, slightly more new positioning coming in on the 58 puts. Then we fall off yet again to the 59 puts, which is a nice little strip there, 60, 59, 58, doing about 25,000 and change of the 59 puts. Again, the lion's share on Wednesday with about just a little bit shy of 2,000 net opening on the week. So 60 strike, kind of back and forth, 58, 59, slightly biased towards the opening this week, which is probably not exactly unexpected given what we saw out there in all things crude this week. There was some call action as well. Also in April, the 65s doing about 18,000 contracts this week. Again, Wednesday being the leadoff day, 5,200 there. Net about 2,600 opening contracts on the week here for all things WTI, followed quickly by the 62s with a little bit north of 17,000 again. Actually Thursday this time leading the charge, and net about 1,800 of that 17,000 opening. So a little bit more opening on the call side. Maybe the late week rally having something to do with that. Let's do our quick scan for our exotic strikes. We see the 90 calls getting a little bit of action in Dees of this year, doing about 3,000, about 2,200 going up on Tuesday, 300 on Monday, and 400 actually today. So they continued to trade sporadically actually throughout the week. It wasn't just one big print. Again, 3,000 and change, 1,600 opening. Kind of interesting. So there actually was some back and forth on the Dees 90s out there this week. We also saw 50 puts trading in June of next year, June of 2019, 1,500 of those. And the par strike is where your heart is set. We saw a few, about 700 of the Dees 2020 par calls, a.k.a. the 100 calls, lighting up the tape out there this week. Mr. Nick, that's kind of what caught my eye out here in WTI. Anything resonating with you this week in the Texas T, sir?
Let's see. So I'm going to focus on sort of we won't look at the April. April expires in about 5 or 6 days, so that doesn't really give us too much of an indication. But, after our conversations the last few weeks, we've been talking about how the vol doesn't seem to be, we didn't, the vol was moving sort of along the vol curve, right? So we were going up and at the money volatility, but we weren't really changing the location or the shape of the vol curve. Meaning, you move from a 62 strike down to a 60 because you're rolling up the vol curve. You're inherently going to have a higher volatility, but the shape of the curve didn't necessarily change much, or the parallel, or there's no parallel shift in the volatility to go up or down. So I've been paying more attention to not only, the at the money volatility, but also just sort of the shifting of the curve throughout the week. And the big difference this week is, we were up. So if we just were running along the vol curve, we would have expected maybe a little bit of a bump in volatility, but we really saw, we call it, for all intents and purposes, we'll call it basically an unch week when it comes right down to it. If we're looking at 78 cents in the front and 78 and 83 cents in the front in the May contract, but vol got hammered pretty good this week with our continued sort of, we had that, we had a little bit of a run up early on, and then we came right back off again, and they took the wind out of it pretty good at this point. So, again, we're ranging. It looks like, just by the shape of the vol curve, it looks like the middle of the range, or the sort of the indifference point, is around the 65 strike, just based on the fact that that's the belly of the vol curve. And we are starting to see our volatility move back down into the lows. I'm going to take a look and see how we look in comparison to Yeah, I mean, if you see the drop today in comparison to where we are, I mean, we're not at 20 yet, but 20 gets us to the point of where there's really the support and resistance to our low volatility for the crude, in particular for the April contract. And I'm sure that if we look at the 30-day constant maturity, we're going to see a similar thing. So again, these rangy trades, they're not doing. Still, obviously, people still like when we move down unexpectedly, and they want to see the rally, which I never understand why they want to see the price of a commodity go up that costs us all more money. But I think this sort of range really got hit pretty good this week, more than we have seen in the last few weeks, with this move back toward our sort of our belly of our vol curves into the higher side of crude that we've seen in the last month or so. So this is a real, when you see the red numbers on the vol, this is a real volatility going down, as opposed maybe to the faux movement up or the faux movement down along the vol curve. It got hit pretty good this week, and so that's what I noticed right off the bat there. I'm getting more insight into these numbers as I pay, sort of closer attention to just the specifics of how the vol is moving. And in particular at the money, we pay attention a lot to the skew. The skew is going to naturally be affected based on, if you're rolling up and down that vol curve, you're going to get a higher put vol, you're going to get a lower call vol, depending on, how many days to expiration we have and how compact that 25 delta is around the money. But, this week, in comparison to where we started, not a big change in terms of the overall 25 delta put and calls relationship to the money, but the big thing to note here is the general slump in volatility and moving back towards this 20 level, and that's going to put us down near the lows for the year, or the calendar year anyway.
Speaking of slump and volatility, I guess that's a perfect segue to lead into the indices. They've been rocking and rolling. Let's talk a little E-mini, Mr. Nick, because it's been rocking and rolling this week as well. And like I mentioned at the top of the show, it's been just, I guess you can call it a vol apocalypse. They're really taking it out there. A lot of this conference was dedicated towards volatility. A lot of people were talking about how the volatility really seemed to have been fundamentally altered by the activity back in February, about a month ago. And it seems like they took a lot of that premium they put in. They took a lot of it out here today, with vol pretty much off across the board, 3 to 4 handles, depending on where you're looking out there in terms of vol out there in the E-mini. Again, on the week, actually, of course, we're up. So apparently trade war, everything else, like we mentioned earlier, apparently a bit of a distant memory. We're up a little over 3%, about 3.3%, Nick, from this time last week. Who would have guessed that at this time last week, when it seemed like everything was melting down, that we'd be back up here? But yet here we are again. Strong week in terms of OI growth as well. 11.5% increase in the E-mini. And we know the E-mini is not exactly an inactive product, so to put up those kinds of numbers, clearly this was yet another rock'em sock'em week. In terms of where the action was this week, Mr. Nick, it was in the March 2,800 calls. That's where really everyone was playing here this week, doing about 42,000 and change on that strike. The lion's share, again, coming today on the heels of that big non-farm and that big rally in the equities out there today. Again, 42,000, 21, half of that coming today. Net, a lot of back and forth on this strike. Only net opening 1,600 net on the week. So of that 42,000, a lot of it was just churning and burning back and forth, which is pretty interesting. Hot on his heels, also coming in number 2, the 2,600 puts, again, also out there in March, and about 37,000 contracts out there. Again, only slightly biased towards the opening, with the lion's share coming on Monday. So a little bit of a tale of two markets, the Monday for the puts and today for the calls out there. So it has been kind of fascinating to watch this, all things considered. Let's go out really quickly and see if we can scroll around, see if we see any interesting strikes that we wouldn't have normally noticed. Actually, the 25 double puts also pretty surprisingly active this week out here in the April. Actually, we always know the weeklies get a lot of action out here. The minis, April, getting a little bit of action this week as well. The 25 double puts doing 13,000 contracts this week. All of that pretty much coming today, 13,000. Looks like, and net on the week. So yeah, the rest of the numbers we have are only only slightly biased towards the opening because there wasn't a lot of volume the rest of the week. Someone putting up 13,010 of those 25.55 puts in April going up today. So a lot of funky stuff. Nick, the listeners are always asking us, what's up with S&P skew? Let's tell them this week. What is up with S&P skew? Did you notice anything of interest, or is it another week where we're pretty much perhaps not as much change as we would have expected?
Again, I probably think it's not as much change as we expect. It's really, and I hate to beat the proverbial dead horse here, but when you look at the vol curve from 3-2 from March 2nd, which was last Friday to today, you're seeing a little bit of you're seeing a little vol off from last week to now. The big change this week in terms of the at the money volatility is just kind of moving. We're 80 handles higher, so just kind of moving from like the 2700 to the 2780. We're really just kind of floating along that vol curve. So yeah, vol's off, and I think that's the part that's interesting for me. We're not really seeing a floating skew here with these vol curves. Floating skew is when the curve sort of drifts along with the at the money and it doesn't change. And Mark, I know you know what it is, but for people that are maybe not paying attention to it so much, it's when the at the money's the curve just sort of floats along the futures line or the at the money strike and keeps its same shape and just sort of moves along. But what we're seeing is we're just seeing this instead of the whole curve moving, you just see the kind of at the money moving up and down on the vol curve itself. So that's why when you go and you look at it, you want to look, you tend to want to look in comparison and keep the strike curve and look at one strike curve versus another strike curve, and you'll see that we're just really we're off. Vol is off this week, but maybe not as significantly as we would expect from looking at the at the money vol. So like I said last week or the week before, we're trying to fit it into the report because we're really space deficient in the TWIFO report is trying to show you what the current at the money, not just what the at the money is, but what the current strike that represents the at the money, how that's changed over the week, because that will give you a more of a clear indication of exactly how much volatility is in, right? So yes, the at the money changed because we shifted along. And I guess the term for that from some people that are smarter than me, I've been asking these questions about is the local volatility, right? So there's going to be things that happen in a area around the at the money, but as much as vol's in, we're in, but we're not in as much as we think because of the fact that we're kind of moving back along toward the belly of the vol curve, and that to me is really what's really making me pay attention these days to see the magnitude of volatility, and that's inherently, if you're moving along an index curve like this, inherently when you go down, you're going to see your quick skew and your regular risk reversal. You're going to see the puts be more expensive, much more expensive than they are to the calls, and the reason that's going to be is because you're just kind of moving up the slope. The curve's not moving itself. If the curve were moving itself, then we would just kind of see the same thing from week over week. So that's why you kind of point out the things where we wanted to in the Treasury, where it was a pretty flat curve between the 25 deltas, because that's a change in that's a change in the shape of the curve based on what the market thinks is going on. And in here, we don't think that the indexes aren't showing us any change in what the market's thinking. It's not even having the curve float along with the futures movement. So I think that's something that just going to make us pay attention and be better served to sort of tell you what's going on with volatility and skew in general. So I'm really trying to pay attention to that more than anything else.
Yeah, that is kind of one of the more fascinating topics for the week, is just how the skew evolves. It's one of the things we were talking about here at the conference. Everyone likes to talk about the at the money level of volatility, but there are so many other contextual elements that go along with it. The skew, like you just mentioned, the futures term structure, what's going on out there, the volatility of volatility, also an important metric. So a lot of things you have to bake into that calculation when you're looking at and trying to analyze. Just front month at the money volatility isn't going to cut it. It's a lot more data you need to crunch. And yeah, the skew out there in S&P has been perhaps a little more interesting, perhaps for its lack of change last few weeks than what it's actually doing out here. I'm doing a quick scan of the metals as we're talking, Mr. Nick, because I know some of the base ones were actually where some of the concern was this week with the tariffs and everything along those lines. Unfortunately, not a lot of options action in a lot of those names. So I think we'll stick with the shiny stuff this week. If you have a nugget or two you want to throw in on some of the base or more production metals, I think we'll allow it this week, Mr. Nick. But out here in gold, it was an interesting week. Gold actually finishing up the week looks like pretty much punched slightly up. So after all this talk of trade wars and sell-offs and rallies, gold kind of finishing the week a little bit unched, which is perhaps an interesting development for a lot of people out there. Vol, though, coming off a little bit, which is, again, kind of like oil. Even though gold vol is cheap, and we had Eric on a couple of weeks ago talking about his research, and he's been beating that drum on cheap gold volatility for some time. We're at or around the 5-year lows, and you're looking at ball cones or things like that, and yet there's still room for it to come off this week, off about a handle to about half a point, depending on where you're looking out there in the term structure. In terms of OI, a decent week, up about 2.8%. So again, gold perhaps not quite responding maybe the way you would have thought, given everything we saw playing out in the market. Not quite as active, not quite as much movement out here in gold as, again, a lot of you probably assumed. If you're looking at where the action was out here in gold this week, it came in June. Well, actually, the total number is pretty close, actually. Total volume of the action was out there in April with 41%, though the number one with a bullet strike actually was a pretty close battle between the April 13 halves and the June 14 halves. Let's go with the April because they edged it out, if ever so slightly. April 13 halves doing 5,100 contracts this week. The lion's share actually coming on Tuesday, 2,100 contracts going up there, 1,000 on Thursday, and almost 1,000 today. So pretty evenly split throughout the week. And nets actually pretty much unched. So a lot of back and forth there on these 13 halves between the rest of the week and today. We also saw, like I mentioned, the 14 halves also pretty active with about just shy of 5,000, 4,800 and change going up. The lion's share actually on Tuesday with about Thursday, 1,800. It's pretty close throughout the week. 1,800 on Thursday, 1,700 on Tuesday, and a whopping 35 going up today, listeners. 4,800 net on the week, net closing about 1,400 contracts out there. So again, kind of interesting paper out here in gold this week. Let's go dig in a little bit more here in the April to see what else was lurking out there. If you said 1,400 calls were number 3, then you're right on the mark with about 4,500 of those going up this week. Of that, 3,996 going up on Tuesday. Pretty much, so nothing pretty much the rest of the week, 26 only today. Of that, about 1,600 net closing on the week. So again, kind of interesting, maybe a little bit surprising or head-scratching paper out there for a lot of the gold traders out there. It doesn't say there weren't a few aberrant prints. Looks like we've got these 1,100 puts going up here in August, actually, going up about 1,100 times, actually. 1,100 of the 1,100 puts, 940 going up on Monday, a couple hundred going up the next day as well. Again, net actually slightly closing. So looks like a little bit of interesting action out there on the 1,100 puts in August. If that's not far enough out of the money for you, listeners, or perhaps far enough down the term structure for you, and we got the DEES par, the DEES 1,000 puts lighting it up with 2,700 contracts, 2,000 of that coming today. So we don't obviously have the OI change on today's paper, but still 1,100 and par puts. Again, perhaps not what you'd expected. Kind of a weird week out here in the shiny stuff, Mr. Nick. Anything catching your eye out here? I mean, weird prints, net, not a lot of net movement on the week. Vol still coming in, even though it's cheap already. A lot of weird stuff. What caught your eye out here in gold this week, sir?
Yeah, I think there's been a lot more chatter about it in general, and some of the moves may not have been as people expected, right? Because we did see a break earlier, and then we saw it come back. But I think again, catching my eye, you always do a good job of talking about what's active and where the action is for the week. But this one, not much change from a skew standpoint, which makes a lot of sense. Again, if we start to take our new perspective in terms of how we're going to look at the vol, so we really kind of started where we ended up. Or we ended up where we started the week, and vol really is in. So you're talking about from a 10.2 all the way to a 9.4. And the 17-day contract, which is the April, that's in a full vol, and that vol's in. So that's not a change in the location along the curve. That's a net change in the volatility. So it got beat down there pretty good on the week. And if we take a look just at general, I'm going to go out and take a look at this from a longer term perspective standpoint. Outside of our little bounce that we had when it kind of hit the fan early in the break of the S&Ps, we're really right back and below at this point where we were from the lows prior to the S&Ps having their initial move down. So it's one of those things. The vol's up. It's up for a very short period of time. People complain about no volatility. It's volatile, and then the volatility goes away. So they want volatility, but they only want it for a little bit, it appears, and then it's right back to where it is. So again, we've said this many times before in the past. When you start to get in, I think we found sort of a new middle range here, just based on what the vol curve looks like and the movement kind of back and forth. So maybe this is the establishment of our new range. But as we go and take a look at this historically, this might be a time to start looking for some sort of rangy trade option type stuff, right? So get a move down, maybe pick up some puts again that are hedged, get a move up, maybe sell some calls and hedge them if you think we're not going to go too much further outside where we're what we're talking about. So I think what catches my eye the most is the fact that we're right back down to the lows, and again, that's going to be interesting to watch again. I don't think that's going to be a surprise. We're gonna, we're already seeing it, but we're probably going to go right back where we were before the big scare. And I wouldn't be surprised. And I didn't listen to the other shows, and you can jump in with the VIX here. I mean, what are we seeing there? Is that trending back towards down indifference or what?
Yeah, it was surprisingly resilient for the longest time. Again, like I mentioned, they even remarked on it at this conference. It seemed like the events of last month really seemed to perhaps have left a mark on the futures out there for quite some time until pretty much the latter half of this week, when we saw the perhaps detente with North Korea and now the great number coming out of the non-farms. That kind of 1-2 punch really seemed to just melt away a lot of the premium that had been put into that near-term vol in the S&P. So yeah, a lot of that coming out. I think it's safe to call it a deluge today, Mr. Nick, in terms of the vol just melting away about as fast as it possibly can. So all the people who were waiting for that return, that erosion to come back in, for those futures to come in, for the vol to come in the S&P, you got that, and you got that in spades today. Whether that will remain or whether we'll get another system shock next week that'll jolt us up. Actually, on our last show, I did wager that we're going to remain here, actually a bit lower in terms of S&P vol. So we'll see if that is what's to come to pass. But yeah, all the people, Nick, who've been waiting for that vol to come in, a little bit of that quote unquote mean reversion out there in volatility land. You got some aggressive reversion out there today. In terms of aggression, let's look here at the movers and shakers for the week out here on the old CME platform. They trade a lot of weird things, a lot of interesting things, and we scan them all for you every week. Listen, this is net performance on the week, so this is just the futures. This isn't, OI or volatility or anything like that from an options perspective. I'm showing a crazy 15.5% increase in lean hogs. But we just talked lean hogs earlier, and it didn't seem like they had moved that much net, so I'm going to discount that one as a little bit of an aberrant print and instead go to number 2 on our list, which will be number 1 for this week out there with the E-mini Russell coming in up 4%, followed by the Nasdaq E-mini, also 100 E-mini, also up nearly 4%. S&P Midcap 400 E-mini up about 3.5%. All indices this week. S&P, our old friend, the S&P 500 E-mini up about a little over 3%, and the Dow E-mini up, the laggard of the bunch, only up 2.8%. A mere 2.8% this week. On the downside, we got iron ore taking it on the chin, nearly 9%. You can probably guess what's driving that. Number 2, soybean meal, about 3.74% to the downside this week. Number 3, EuroDollars, off about 3.25%. Number 4, Casey wheat, and number 5, just plain old wheat, off about 2.6% there as well. So that's your movers and shakers in terms of what was really rocking and rolling this week out there in the universe of products on Globex. Now let's keep on rolling. Let's see what's rolling with you guys, actually, with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, the portion of the show where you guys get to weigh in, questions, comments, insights, all of that good stuff. Let's kick it off here, Nick. This one's been sitting in our feedback pile for a while. This person's been very patient. Let's get to them. Nas3T, I guess that's how you pronounce that. I wants to know, is it possible to hedge some of these aggregate commodity ETFs with puts in their underlying itself? So hedge USO with WTI puts, corn with corn puts. You get the idea. Yeah, I get the idea there, Nas3T. It's not a thing I typically advocate for a lot of people because you're not doing apples to apples. You know, you're doing apples to maybe apples with a little bit of oranges and everything else thrown in. The problem is a lot of these ETFs that don't hold the physical, like, you know, GLD holds the physical, so you usually get a nice a little bit more correlation in terms of what's going on with the underlying and what's going on with the ETF. They track each other pretty well. When you get to these other ones that attempt to replicate things with baskets of futures, that's when things get a little bit more dicey, because obviously the choice then becomes which futures do you use? Do you use front month? Do you use mid curve? Do you use longer dated contracts? And then you have that negative roll yield that impacts a lot of these ETFs, because they're typically buying usually longer term contracts and maybe selling nearer terms. Again, it depends how often they rebalance as well. So there's a lot that goes into these hedging. Now, clearly there is a relationship. If you look at, let's say, WTI and USO, for example, their volatility tends to move pretty closely. So there is a back and forth relationship between these two large vol trades going up between the two and hedging trades. So it can be done. But I think for a lot of the audience of this show, which is, the active retail, is not something I would recommend. If you want to do that, I think you should stick really with the products that tend to hold the physical rather than have baskets of futures. Because whenever you have these kind of Franken products putting together baskets of futures trying to replicate something else, there's challenges with how well they line up, how well they track the underlying, and again, how well you can line up from a hedging perspective with these. I don't know, Nick, are you as uncomfortable about that in terms of people going out there and trying to do that as I am? Because again, these products usually trying to replicate things with baskets of futures, and your mileage is going to vary depending on the product and how well they do. So it's kind of hard to talk about them all under one lump sum. But in general, I tend to recommend people tend to go for the ones that hold the physical, because that you don't have to deal with these kind of negative roll yield issues that impact a lot of these other products. Are you on the same tip there, Mr. Nick?
Yeah, I think you got to be careful. And again, not only knowing what I know, not knowing that much. I think the USO is a pretty bad one from a roll perspective.
Yes.
So I think that you get beat up pretty good there. I have heard that the AIU or the IAU in the gold is pretty good in terms of keeping its costs down. So that one might be something that you can do. But again, it's difficult because that's trading in like the from the $11.5 to $13 range over the last whatever year, and gold is all over the place. So I don't even know that I would say you typically want to stay away from non-fungible hedging products, right? So you don't want to go in one market and hedge against another. It's one thing to do the SPX against the S&P, because they're, even though they're not the same clearinghouse, but at least they're going to move fairly similarly, whereas USO and the crude, you may not necessarily see that. So I don't ever like the idea of doing that. And Mark, I wanted to touch on one thing you said prior to moving on. In the performance tool, Mark, I went and looked at that lean hogs because it concerned me, but that tool defaults to showing the most open interest contracts. So over the course of that week, what happened is it went from one contract to another. So that's why you saw the wackiness of it. because it went from the April to the June. So
I assume that was a bit of an aberrant print because I didn't see lean hogs moving 15% this week. That would have been certainly quite the story if that had been the case. So that I kind of thought we needed to explain that one. So I'm glad.
Well, you could if you click on that bar, it'll show you the two contracts it takes into account for each of the different days, and then also in the settings it will let you go to just do the front month. And then when I did the front month only, it showed basically no change in the lean hogs for the week. So just as a tip, as you go forward using that, and for anybody else out there using that tool on the CME Group website or within Essentials or the product itself.
There you go. Pro tip for when you're scanning the movers and shakers for yourselves, listeners. Make sure you get those. You get the settings correct. Listen, we got a question here from Dante. Dante, we kind of addressed this already on the show. He wants to know: are the commodity markets buying this trade war talk? Well, we kind of just went through a lot of different product complexes there, Dante. So I think you can make a determination for what we were talking about. But it sounds like earlier in the week, a lot of people were buying this, and there was a lot of concern. There was a lot of volatility. And towards the latter part, we just went through gold, for example. Gold ended up net on the week kind of unched. And, we talked about the S&P skew not really doing a heck of a lot. Crude having the slight uptick this week, but not a ton. Lean hogs had a bit of a crazy, wild week. Not quite as wild as that number would have suggested, but still a pretty wild week. So there were certain pockets, obviously. If there was if there was a big thriving aluminum options market to talk about, maybe we can get into some of that. Unfortunately, not really. So we're kind of limited on some of those specific products that they were focusing the tariffs on, like the aluminum and the steel. But still, it's interesting stuff. Nick, perhaps would you concur that maybe the net result was towards the end of the week, a lot of those concerns seem a little bit mitigated?
Well, I think as is common, we tend to get an overstatement from our president to get a reaction, and then it comes back more toward the center in terms of the actual implementation, as we saw, giving Canada and Mexico a break on the tariffs, and then also allowing others to negotiate the same. So it's, a ridiculous statement leading to an overreaction, which then comes back to the norm, which maybe that's the policy. But yeah, I think that it probably, it's like anything, right? The sky's falling, and then you react as if the sky's falling, like that commercial with the meteor coming and people are ripping the TVs off the wall and throwing everything into their car, and then things kind of settle back in. And we've seen the same thing, right? I mean, we saw the same thing in the general market, right? We saw the big reaction to the S&Ps thinking the world was coming to an end, and then the next thing we're right back where we were, and the vol is coming back in. I'd be more I think what people got to do, and again, just my opinion, is pay attention to the undertones as to the almost like the undercurrent or the riptides you can't see what's going on in the lake. You might see the waves coming in, but there's probably worse going on underneath. I'd be more concerned about just the kind of the instability in the bond market and stuff like that than anything else, because that seems to be where the bigger problem is going to be. If there's a problem with the way people think about us, our debt could take a real big hit. So yes, I guess the short answer to my long response is, yeah, probably is overdone and probably back to normal a little bit, and have to see what happens as usual, right?
A long way around to that, but we got there in the end. Spoken like a true EuroDollars guy, looking at the debt and everything else like that. It's interesting. I mentioned before, Nick, our listeners like to give us homework, and we got this question. I think falls under the homework category. This comes from Tom B. He's asking: is it the same cost over time to buy calls in ags or metals where the premium is to the upside as it is to hedge the index with downside puts? Just trying to figure out my skews. Keep the show coming. This is an interesting comparison. Anecdotally, I've seen a lot of studies on the index numbers. So usually, obviously it's going to depend where you hedge, where you buy the puts, how often you roll, that sort of thing. But usually the numbers tend to fall out around somewhere between like 8 and 10% for the cost of hedging your portfolio. If you just went out and just bought puts every, let's say, 2 to 3 months and let them expire worthless and kept doing that. So that's typically where the ballpark cost falls for hedging something like the S&P with puts, where, of course, we all know the premium is to the downside. Now, he's mentioning the premiums to the upside in the ags or the metals. That isn't always the case. It's the case a lot of the time, particularly in gold. It has been of late, where people are interested in, the gold bugs want to get out there and they bid up the call skew, but it's not always the case. So I don't know if it's quite exactly an apples to apples kind of comparison, but it is kind of an interesting idea. Maybe it's worth a little bit of investigation, Mr. Nick. We'll have to compare and contrast. Maybe let's say if you wanted to pick up the upside in gold and you wanted to just do that throughout the year, maybe we pick a certain level, I don't know, 5 or 10% out of the money, and we say, how much is that going to cost you net over time, factoring in that skew premium that tends to be there in calls, not all the time, but tends to be there in the calls. And then is that going to add up to a similar amount to like the 8 to 10% you're going to lose in the S&P? That's an interesting question. I don't know the answer off the top of my head, hence the homework question. What do you think, Mr. Nick?
Yeah, I would have to. I mean, I'd have to look, obviously, to have a more complete answer. But that one, I think, that could be costly, just because, for instance, if you buy the calls and the market moves up, it doesn't necessarily mean that you gain any benefit from your calls. You could definitely move up, and the call value could stay or even get hit if volatility gets tagged a little bit as you move up towards that strike. If you feel like you want to, maybe capture some of the upside in gold, for instance, or in ags, and you can find a cheaper, downside option and then hedge that option. You can benefit from a move up because you're long some deltas against the put, and you could also maybe take advantage of the fact that you're covered if the market happens to go down as well. So I don't know. I don't necessarily know that I look at it as location on low strike location, and more of overall what you get by purchasing that volatility strike or the gamma in that strike. So and that's a big question to answer, and it's probably a lot of people doing studies on that to see what the best thing is. But I would tend to say see what the vol of those strikes are, and if you can do something to get into the cheaper strikes to take advantage of that, along with the potential direction of that particular commodity, I would look at that first.
You need to do a study, Nick, on a strangle with a gold call leg and S&P put leg, and see how that fares over time. Maybe that'd be a bit of a funky one to commission, but that's kind of what he's asking out there, which is interesting. Again, I haven't thought of it precisely in those terms before, which is why I like the listeners. They throw us the curveballs. Speaking of curve, we got another Tom Ben. I wonder if it's the same guys before. If it is, I usually limit him to one, but he snuck it in, so he's lucky. He's got a comment this time. He says, you guys should put together a commodity volatility and skew event. I think that would draw a lot of people, since no one outside of you guys seems to be talking about this stuff. Well, there we go, Nick. We should have our own conference. What do you think? He thinks apparently we're the only ones talking, which he kind of is right. There aren't a lot of people beating the drum for this stuff outside of us in our weekly Twice. That's why we created Twifo, right? It was kind of an unheralded part of the marketplace. And who knows? Maybe that'll be next for us, our big conference. Where should we hold it? Down here, frozen Minneapolis. Where should we go, Nick?
Well, I mean, don't we sort of we have a weekly conference, so to speak, right? We're doing it every Friday. Hey, if
we're spanning the coasts today, so yeah.
If more than me, you, and Tom would show up, I'd be glad to do it. It'd be fun.
Okay, let's have Tom do the legwork. Let's have Tom investigate venues and get us back some quotes and things, and then we'll kind of go from there. So there you go, Tom. That's our homework back to you. You tell us where you want to have it. Maybe somewhere nice and warm. Maybe a nice Orlando. You bring the family. You never know. All sorts of fun stuff we could do. But I thought that was a fun suggestion there, Mr. Nick. Let's wrap it up on this one. This comes from Lev 18. They're asking, they like you, Nick. They say they agree with you on the inverse volatility product. I think that's what we were talking about last week. You got a chance to finally chime in on this, Nick. Sounds like he agrees with you, or perhaps she. You don't know who Lev 18 is. Going on to say they are a dangerous space for the uninitiated. Interesting that none really exist for the commodity realm. So it follows then, would you like to see them? And if so, on which products? A lot of people have asked similar questions ever since the whole inverse vol space kind of blew up. Why don't we see these on the commodities? Is there a need for them? Commodity vol in general has been a challenging space, I think, from a product perspective. CME has tried. CME has even partnered with SIBO on some products. There is out there a GVZ, which is a gold VIX. There is OIV, which is an oil VIX. There's even OVX, which is USO-based oil VIX, if you like to go that way. So there are a lot of commodity volatility products. And you think it would be chocolate and peanut butter, Nick, two great tastes that taste great together. You take commodity, you take something people like to trade like gold or an oil, and you take something people also like to trade like volatility, aka VIX, and you put them together. That would make a home run product. And yet, for whatever reason, the products never really traded. There's futures on them slightly, at least on the GBZ and some others out. I'm not sure if OIV even has the underlying anymore trading, but there are just disseminated indices out there. They don't even really trade. So the long vol never took off, let alone there being a market for the inverse volatility of these things. So I don't know. Maybe I'd like to see more interest and more trading in the actual long vol products first, or just the vol products, before we see a need for a short. I don't think you're going to have any success convincing anyone when the original vol products didn't take off. Who's going to go out and launch an inverse? Plus, I think in this regulatory environment, I think getting any sort of inverse volatility product approved a lot more challenging than it would have been, let's say, a month ago. I think let's put it that way. Are you on board with that, Mr. Nick, too? And are you as surprised as I was that when they created these commodity volatility products a few years ago, that they never really took off? It seemed like it was a home run, and yet it kind of withered on the vine for whatever reason.
Yeah, I mean, that was actually going to be my comment, because I love that kind of stuff, because it sort of gives you, an aggregate view of what's going on, and it is sort of a little bit surprising. But I think part of that is because the guys are the I should say, I try to go neutral. The guys and gals that are trading those products are not necessarily going to move to that part of it. But I still think that. I mean, I think there's supposed to be one on the 10-year too, right? There's a VIX on the 10-year too, I believe.
Yes,
that doesn't do anything at the SIBO either. So you would, but then again, you want to think. I was thinking more of it from a funny standpoint with the inverse volatility. With the way some of this volatility is trending lower, you'd get like these infinity, just like we saw with the index itself. But yeah, I am surprised, because I think that would be. I just think it's good from. It's sort of like they have the dollar index, right? The dollar index trades over at that other exchange, and it's a good number. I don't think it's very popular, but it is a good number, and it is kind of representative, and it does give a good indication of direction and that type of thing. So yeah, I think I would love, I don't know, do they have those and there's no options on that stuff? Is that why? Or, that's kind of the thing. I mean, maybe they need to create a market for that more than just throw out those numbers. And maybe they come with a complete market with both the underlying, the future, and the options to get people interested. And don't know though, but yeah, I would have expected more.
Yeah, they started with the index being disseminated, and they went to the futures, and they never really progressed much beyond that. I'm just kind of pulling it up now to make sure to see what is going up in these. Yeah, we got. There's no there's no options on GVZ here. I'm looking to see if I see any volume on this thing. Not much really today at all. Let's look at OIV as well. That's the ticker for the WTI of VIX. And in terms of, this is just showing me levels. It's not showing me any prints out here whatsoever. So I know there was a GVZ future that did trade almost by appointment. I'm not sure if that's even going up. I'll have to dig in a little bit to see. But yeah, it's maybe the flip side. Maybe you're right. Maybe the flip side is the inverse trade has been so popular of late. Maybe if they had an inverse, certainly inverse vol in gold and crude has been a decent play over the last year, as it came in so aggressively. Maybe not the last month or two when things have been moving around a bit. But so maybe that would have, ironically, Nick, maybe that's what they needed to do. They needed to launch an inverse, which would have sparked interest in the regular contract. Maybe now it's too late. I don't know. Either way, it's also too late for this show, listeners, because that means we're pretty much come to the end of another. Look how much we like answering your questions. We went a little long for you, but hey, we always love when you guys throw us curveballs here. As Nick mentioned, you can head on over cmegroup.com/Twifo, and you could kind of kick the tires for yourself on all things Twifo. And of course, you should always head on over to bantix.com to see what the gang has cooking over there. Mr. Nick, if they head over to bantix.com, what are they going to see this week?
Oh, what do we got this week? Oh, there's some good stuff coming out. So you just gotta keep keep tuned in as we move towards the release of some of these tools. We got a real nice calculator coming out that's going to be available on the CME website, and as always, enhancements to the tools out in the QuickStrike platform itself. But if you get a chance, go out and look for the strategy simulator out on the CME Group website. We built that and released it a couple of weeks ago, and take a look, give us some feedback. I know Mark tweeted that out, but we'd like to hear what you have to say about that. But if you have any specific questions, just reach out and we'll get back to you.
There you go. Check it out, bandtix.com, to learn more. On behalf of Mr. Nick and our friends over there at CME, and indeed myself, I want to thank all of you for joining us on this live and sunny edition of TWIFO. Nice to do it in the nice warm weather here in Florida for a change, a little bit of a fun thing. I'll be back in the studio next week. We'll see you then for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bandtix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QuickStrike1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.